business analyst at Sunidhi Securities joining in. Chintan, thanks for taking the time out today. Your first reaction as far as the numbers are concerned, and what do you make of it?
The numbers were quite decent, a tad, as you said, a tad our expectations. Indian operations were quite in line with what Street and we were expecting. We were expecting a bit per ton of 15,000 rupees for Indian operations, and that was precisely in line, 15,115 per ton. Indian operation, however, surpassed our expectation. We were expecting around $23-24 per ton for European operations, and after one off. The number works out to be $33 per ton. Otherwise, prima facie it was 43, but some company received around $37 million from electricity dues, kind of a one-off. So adjusted to that, $33 per ton, it's quite reasonable, well above the expectations, but not enough actually. The point I'm trying to make is that there are certain points which we and Street might not be comfortable with. It's a debt position actually at this point of time, 70,000 odd crores on a net debt level. That sometimes tends to affect investor bid, because 18,000 odd crores EBITDA what we are looking at on a consolidated basis, and on that basis this works out to be around quarter to 4 times net debt to EBITDA. That kind of poses a risk actually. And even the management commentary is that down the line 12 to 15 months they do not expect any kind of debt level going below this level, and however they are going for a capital of 9,000 odd crores for its Odisha project, plus Jamshedpur capex, maintenance capex, plus European operation capex. So what we understand is that the free cash flow which the company will be generating for next year would be utilized for its capex, and they might even draw down further debt actually to finance that. So when the debt level doesn't seem to be getting improved from here on actually. So even a blue sky scenario of a 16,000 rupees or ton EBITDA for Indian operations and a full capacity of 9 million tons, we work out to around 14,400, 15,000 odd crores EBITDA for the company, which translates around 90,000 crores for enterprise value for Tata.
So Chintan, one point's very clear out here, that you've got that whole debt figure being a huge overhang, no doubt, for the company going forward from here. But purely in terms of the European operation, because the market was watching that pretty closely as well. How did that pan out? Is the market surprised to a certain extent? Because the guidance also seems to be at the higher end.
No doubt about it. See, again, there are two things to it actually to watch out. The first thing is that no doubt they have surpassed it by $7-8 from what market were expecting, but this has nothing to completely do with the cost efficiency program we are doing it. As prima facie, as we understand, European operations raw material effects come with a 45 to 16 days lag effect, and that was quite visible. But however, we cannot take out the credit of what the company has been doing for years now in terms of its cost efficiencies. What we understand is $25 to $30 is possible on a sustainable basis from here on. But even taking that into account, the company has built in 2.6 million tons of inventory actually for this. Even a full bank capacity, it doesn't justify the valuation at this point of time. What I'm trying to make it understand is that even when I expect a $3,000 odd EBITDA, which is $50 odd actually, it's a 5,000 odd crores EBITDA what they can make it in a very optimistic scenario actually, and even of 5 times multiple of that, 25,000 odd enterprise value. So on a combined basis, it's still the fair value of the company doesn't justify 370 beyond 373 actually. So it will take a time. It's difficult to go aggressive on this at this point of time. Considering the debt position actually.
The other interesting bit out here when we talk about the operational front, as you mentioned, Chintan, in terms of the ratios, in terms of the way the operations is actually panned out, how do you expect the Street to react to the EBITDA per ton and the margins that they've actually posted both on a consolidated basis as well as the domestic business?
Domestic was quite expectations. there was no doubt about it. We were expecting 15,000. In fact, the quarter 4 could be better because kind of price hikes they have taken in December and January. So we can expect 500 to 700 rupees EBITDA per ton. But even at the same time, they cautioned it because the Jamshedpur, the new mill actually, so they are selling more of hot rolled coil, which is not a value-added product. That might mitigate the completely price hike taken actually. However, European operations, for the matter of fact, people will take it positively. For last 3 quarters, we have been seeing that company is able to post it a positive EBITDA dollar per ton, and there is less volatility is concerned. So definitely some cost synergies are moving, no doubt about it. But taking an aggressive call from here on would be quite a risky bet actually.
And that's a fair point, Chintan, for the simple reason the stocks also run up quite significantly. We're talking for that stock almost having 60-65% gains in the last 3 to 6 months. 6 months, I think that's the kind of gain the stocks actually posted. So on the back of the way earnings have panned out, Chintan, what's the call? What would you recommend clients to do today?
Definitely see there's quite it's a mixed bag actually on operation funds when they have scored a grounding point in by posting some meager gains in European operations above street and analyst expectations. But however, they have not moved much beyond, and there are a couple of questions which need to be answered. So, for example, say MISHA Commission report which is out capping iron ore production in Odisha. What happened if they cap it, and the additional projects that are coming up in Odisha of 3 million tons, how do they try to fund those iron ore requirement? So there are some back end concerns for those companies. So we won't go bang on the stock and say buy at this level. We expect that if it's a good entry point, if it corrects and comes around 320 to 30 odd levels, 380 looks quite justifiable. 380, 390 what will look, it's quite a fair price actually. And if it's however, the only solution for this company is to sell off the investments. That's what will keep the stock price actually market and will anticipate it from time to time to sell off, liquidate those investments. Actually, they would jump off Tata Motors and Titan actually. So that will keep the faith hanging on the stock because that's a considerable portion actually. So that's a critical point actually for the stock.
Alright, Chintan, a lot to discuss when it comes to the metal space. Thank you so much for taking out the time and speaking with us and giving your calls for the day. That's the call coming in for Tata Steel, but what about the market as a whole?